Imagine you own a brand new laptop. Today, it's worth $2,000. A new model is launching next month, and you believe the current model will lose value. So you find a buyer today and agree to sell your laptop for $2,000 1 month from now. A month later, the new model is released. The market value of your laptop has dropped to $1,600. But because of your earlier agreement, the buyer still has to pay $2,000. You receive more than the laptop's current market value. The drop in price worked in your favor. This is exactly how a short position works. When you take a short position, you are agreeing to sell an asset at a fixed price because you believe its value will decrease. If the market price falls below your agreed price, your position becomes more valuable. Imagine you enter a forward contract to sell 1,000 barrels of oil at $80 per barrel. 6 months later, oil is trading at $65. The market says the oil is worth $65, but your contract allows you to sell it for $80. That difference is your gain. The lower the market price falls below your agreed price, the more valuable your short position becomes. That's why investors with a short position want prices to go down. A falling market works in their favor.